Hey, good morning, everybody. For the last coffee with Kirk for the year. Next one will be in the new year. And apologize, I'm a couple minutes late. Uh, just got back this week from Florida and was trying to add some ice on the car and could not find it. My wife and daughter didn't have ice scrapers in the car, so they run all down in the basement to find the ice scrapers, and so it took me a little while to get going, to get here. Anyway, this is our last presentation. I just did strictly about a merger for Picket Fence Financial into a new firm. I'm going to have more information out for clients. If you're a client listening in, you'll get more. I'm going to do some just quick interviews with everybody on the team and get those out to you so you can start to get the feel for the quality of folks that we've got on the team and then just get to know them a little bit personally. So look for that probably shortly after Christmas. Anyway, so this week we'll talk a little bit. You know, everybody always does predictions at the end of the year, and I'm way past that. I've lost the ability to predict anything with this market. I have thought that a lot of the craziness in the market would have been gone when interest rates went up to 5%. I thought we'd finally start to see a more normalized market. Back in 2000 and in 2008, roughly, or 2007, when rates went up, that basically brought sanity to some crazy markets. Interest rates go up and money can go there as a viable alternative. It forces everybody to think more rationally on the stock market. And it just hasn't happened. In fact, it's gotten even crazier. It definitely feels like somewhere in the tech bubble of, say, 97 to 2000. Where are we at right now? If we go back to 2000, we near the end, or we at the beginning? I don't know. I thought we might have seen some sort of sanity, but we haven't. So I'm just going to go through and just once again sort of reiterate, while it's certainly not sexy, you still have to think like an investor. You have to think, am I getting value for the companies I'm buying today? And remember that investing is always trying to predict what kind of cash flows, meaning earnings, are you going to get back for your current investment. And you have to look at it at earnings per share. You could even be with a company that's growing fast, but if you're paying too high a price, your total return, in theory, will be less. So, like I always like to do, let's jump into some slides and get this thing rolling. So as I kind of mentioned, right now, if you look at it, with rates where they're at today, interest rates where they're at today, you actually have a better yield on your cash in bonds than you do the yield on stocks, which is a pretty unique event. It doesn't happen very often. So this chart just sort of shows you the S&P 500 earnings yield compared to the 3-month Treasury bill. And so anytime that stocks are yielding more than the 3-month Treasury, it would be above zero. And anytime it's trading less than that, it's going to be below zero. Now, what is the S&P 500 earnings yield? What that is, a lot of times on this podcast, we talk about price to earnings for the market. So you take the price of the stock divided by the earnings. Well, the earnings yield is just the opposite. So you take the earnings and you divide it by the price. So it's just an inverse of the price to earnings. So if you take the inverse of the price to earnings, or the earnings yield, and then subtract out the 3-month Treasury bill interest rate, that's what you're looking at here. And what you can usually see is when you get to the point where bonds are actually better value than stocks, which is highlighted by the dark blue in each instance here. Not usually some good times for stocks. You go back to like 1970, 74, both of those were some bear markets. And then we have 81 in there. We've got 87 in there as well. And then, of course, you've got, 2000. What's interesting is in 08, 07, 08, you didn't see that happen. It never got to the point where the 3-month treasury was better than the S&P 500 earnings yield. Now, if you also look at the years, basically 96 to 99. So back in the tech bubble, it stayed like this for quite some time. We were talking probably 3-4 years there where we had this exist. So right now we've broken into that realm, but we haven't been there for 3 or 4 years like the tech bubble. So that could mean that the craziness could continue. But typically, this is not a good sign, and it means you need to look for better value. And as I've been talking with people who watch this for a long time, we're in a position where there's just a very few handful of stocks that are driving the market. So when the S&P goes up, 40% of the S&P right now is concentrated in 10 stocks. That's just not very healthy. This chart kind of shows you going back to 1999, there are, again, a very concentrated market. You can see the 10 stocks then, Microsoft, which is still there today, but Intel, Cisco, Oracle, you can read the names there. They made up, which basically was about 28% of the enterprise value compared to GDP of the entire stock market. But today, the 10 stocks make up sizably more of the enterprise value of stocks compared to the gross domestic product. Again, GDP is the total value of all the goods and services produced in our economy. So this is just really just crazy. The variance there, that's not a healthy situation to be in. Giving you another little chart. If you take the NASDAQ 100, divide it by the S&P 500, you can kind of see back in 2000, 99, 2000, we got to the point where the NASDAQ just overwhelmed the S&P 500. And we're now, ever since that crash in 08, we've kind of seen it just steadily climb up at that point. And we're at a point now where the tech sector is just so much bigger than the overall S&P 500. Will that continue? It very well could, but when you're looking at one sector of the economy that's so much bigger than the rest of the sectors in the S&P 500, it's something you need to be alarmed about. In fact, since the bottom, back in 02, you're looking that the NASDAQ has basically, more than doubled what the S&P 500 has overall. So it's not that, tech stocks are always, their higher profit margins definitely can grow a lot quicker. So there are some things to justify the NASDAQ outpacing the S&P 500 overall. But you have to still remember, you're looking for cash flow coming back to you as an investor. And that's what's sort of key. The other thing, we kind of alluded to this with the first chart when we said that the earnings yield is awfully low relative to the 3-month treasury, but this is just kind of looking at the forward price to earnings. So again, we're kind of hitting levels that, were extreme. We're back up and actually exceeded 2021, still a little bit below where we were for 99. So that could mean that we still have some more room to run on the price to earnings, but you also have to remember, like, in 99, the market dropped 50% over the ensuing 3 years. So, do we really want to get to that level if that's what the end result is going to be? And then getting into some stocks, start to talk about some of these 10 stocks that are really driving the market. One of them I look at is Apple. Now, Apple is a phenomenal company. Everybody knows that. Its products are very sticky. People love Apple products. It's a great company. There's no question about it. But it's just getting the point. It's not the company it used to be. It's not the high growth. When they came out with the iPhone, it was just growth was massive. I mean, you're talking 100% year over year growth for several years, as the world started to get their iPhones. And now pretty much everybody who's going to have an iPhone does have an iPhone for the most part. Certainly there's some parts of the emerging market world that, may not, but the extreme growth part of the story is over, and they're a very mature company. They still do a ton in sales. They still have a lot of earnings. It's a great company. But again, you have to look at what are you paying for that company? So right now, the price to earnings on Apple is actually, this chart's a little bit old. It's at 10 to 1. So you're paying $10 for every dollar of sales. Now, this isn't earnings. This is sales. So in theory, it would take you 10 years to get your money back if you could get every dollar of sales in your pocket, but you can't get every dollar of sales. They still have to actually, pay for their employees. They have to pay for their plants. They have to pay for their shipping. They have to pay for all the inputs to the iPhones and everything like that. So this isn't even, to earnings. This is just pure sales. And I've shown the quote before. I should have put it in here now, from Scott McNealy, who was the CEO of Sun Microsystems. And essentially what McNealy said, this was after the fact, I think it was probably 05, 06, after the tech bubble burst. He was like, look, you were paying 10 times sales for my stock. He goes, that was before I paid my employees. That was before I did research and development. That was before I did marketing. That was before I did all my inputs to the products. He goes, what were you thinking? That's what his final line was in this quote that he had. And here we are with a very mature Apple company that is now trading at its, sizably higher than it was even during the high growth phase. So the average going back to the mid 80s for Apple was 2.76 times sales. And this is even including, their high growth period. The only time it came close to where it's at now, if you look at the chart around 2000, I guess probably 8 or 9, when it hit over 6, that's when the iPhone came out. That was when their revolutionary, their moneymaker came out to the market. And that's when, you probably saw or could justify a much higher valuation on that because they were just growing so rapidly. So just a lot of fluff there. And I'll show you some other numbers. So this is Tesla. You can kind of look at this, it's trading its forward price to earnings. So meaning what they expect next year, it's trading 121 times earnings. So again, in theory, if earnings were to stay flat, which they're not, but if they were, it would take you 121 years to get your money back. So you've got to be growing. The company has to be growing at close to triple digits in order to justify something like this. Price to sales at 15. So, I just talked about Apple being at 10, being expensive. This is at 15. Price to book. And what is book? Book is basically what you consider the value if you took all their assets. So if you were going to basically restart the company, what's the value of just building the factories and everything that they own? And it's at almost 20 to 1, which is just ridiculous. And an enterprise value to revenue really high at 13. And of course, compared to its earnings, it's at 96. I mean, it's ridiculous. Even NVIDIA. So NVIDIA is, on the pulse of the AI revolution. But it's, and you could say, all right, forward price to earnings of 31, the past 12 months, it's trading at 53 times. Okay, so they're clearly expecting some rapid growth on their earnings to get at 31. Maybe 31 is okay. If you're talking about a company that is growing at 100% a year, but you also have to look at the market cap at the top line here. It's at $3 trillion. How many times can it grow at 100%? In all seriousness, when you look at it and you say, okay, our total gross domestic product is 24 trillion. Is it worth 1/8 of the economy? And can it grow at 100% a year, like 2 or 3 years? It would be the size of the GDP, the value of the company. Not that it's not a great company, but is it really worth that? And right now, price to sales at close to 30. Price to book at over 50. Now, it isn't a heavy production company. It mostly does the back-end intelligence for a lot of the chips, and then they outsource the actual production. But still, this is pretty ridiculous valuations for anything. And I don't know when it's going to happen, but I think a year, 10 years, people can look back on this like they did Cisco in the year 2000, go, yeah, I think it's a great company. We definitely were paying way too much for it. Now, Facebook's actually not, if you're going to go in one of the 10 stocks that are crazy, a huge part of the market, it's not all that bad. For price to earnings at 23, that's not outrageous at all. Price to sales at 10, that's okay. All right, that's high. And same with the price to book. So when you compare it to some of those numbers, yeah, it's trading awfully high. But, again, it's a company that doesn't have a whole heck of a lot of overhead outside of people. It's, computer based. So on the price to earnings ratio, not too shabby, but still awfully expensive if you use any kind of normal valuation metrics. Microsoft, another company that typically doesn't have a lot of overhead. So again, a great company. 33 price to earnings, maybe I could justify that. Of course, it's a $3 trillion company, so is it going to grow that fast? But still, price to sales, almost 13. Price to book, almost 12. Awfully expensive. Really, really expensive, even compared to historical. Then you look at a couple, let's say a couple value stocks. These companies are not growing anywhere near the companies I've just mentioned. But again, as an investor, growth is great, but you also make sure that your investment's going to generate cash flow back to you, meaning earnings. So this is AT&T, boring company. Right now, their forward price to earnings for expectations are 10. That's earnings, not sales. So, again, if you go back and you look at Tesla, Nvidia, the other, you're looking at a minimum of 33, or it could be up over 100 for price to earnings. Here you have 10. Price to sales, 1 times price to sales. So, you just start to look at these, you go, well, which one would actually might be a better investment? If they can even hit their growth numbers, which are way, way smaller than some of those high-flying tech stocks, over time, you should generate a better return because you're paying so much less for it. Kind of compare it to if you're going to buy a rental home. You could buy a rental home in right on the beach, hip area, but you're going to pay just a boatload, so that when you look at the rents, your price to pay for the house compared to the rents that it generates might be awfully high. But you think it's a hip area, it's on the beach. This is where I need to go. Or you go inland, so maybe the Midwest, and you find a house. It's not sexy, but look, it's, for the price you're paying for the house, the rents you receive really make it pretty compelling. Which one would you rather have? Now, in the example of the house, maybe you still take the beach house because you can go use it yourself and enjoy it. But, as far as a pure investment, you're probably going to go to the house that's stuck in the middle of the Midwest. Here's ExxonMobil. ExxonMobil, clearly a phenomenal company, the largest oil company. And you can kind of see it's trading at a forward price to earnings of close to 12, price to sales 1.3, price to book 1.7. So again, it's pretty clear that while growth may not be rapid on energy, it certainly is not going away. And the price you're paying for these companies is really compelling compared to some of the high flyers. And the big thing is, you just look at it right now, it just feels kind of like 2000, the mania. What this chart shows you is the S&P 500 in blue compared to what we call the leveraged long ETFs divided by the leveraged short ETFs. So this is just trying to compare how many people are leveraging their investment on longs, expecting it to go up, versus leveraging on shorts, expecting it to go down. So you can see there's a lot of leverage, and everybody thinks markets are going to go up, and that has pretty strong correlation. So right now it's still in an uptrend for sure, and it's something to watch. But when this starts to turn and people start to go short, or even if they don't go as long, that's when things could get a little crazy. But a lot of this is people on Robinhood, young investors who've never really been in a bear market or really don't really understand investing. They're just chasing and they're using leverage to do it. And it's, the thing about valuations is they're a horrible short-term predictor. I've said this all the time, but they're pretty good at giving you an idea of what you could expect in the next 5, 10, years like that. And even like Goldman Sachs is kind of jumping out there and saying, look, based on valuations right now, we probably are looking at maybe a 3% return on the S&P 500 over the next decade. And then there are other really smart people talking about this same kind of thing, really look at strong valuations and say, yeah, I don't know what's going to happen the next 6 months, the next year. But, when you talk about the next few years, valuations really do matter. And value stocks, especially recently, have, I think this is 13 days in a row they went down. So nobody wants value stocks. It's been left for dead compared to, the high flyers. And I don't know when that's going to end, but you can start to see that pretty compelling values out there, but you have to be a patient investor. You can't look day to day at what's happening with that. This is just another chart. This is the Warren Buffett, his favorite indicator. And what this does is it takes the value of all the stocks on the stock market and compares it to the gross domestic product. Again, the gross domestic product's the total amount of services and products that are purchased in the economy. It's the size of the economy. And when you look at the number or the size of the publicly traded markets, you have to remember that the vast majority of our GDP is done by small companies that are not publicly traded. Small business is still the backbone of America. So what he does is he tries to say, well, how much is the current stock market relative to the total size of the economy? And when that gets too big, typically stocks are not a good purchase point. And right now it's roughly 2 times the size of GDP. And even back in 2000, it hit 163%. And right now we're well above that. So clearly some froth in it. And if you want to, if you go back to say, look at 1981 there, when Reagan came into office and we were at 32%. So that was really a cheap time to be jumping into the markets. And speaking of Buffett, I just sort of watch what he does. He'll admit he doesn't try to time markets. He doesn't try to, do anything like that. He just looks for, am I getting value for my investments? That's it. That's all he looks at. And, right now he's just really not seeing that. So this chart shows you the total amount of cash that Buffett has on hand as a percentage of total assets. So this kind of accounts for the growth of the company over time. So as their assets continue to grow over time, this compares cash to that. And you can see right now, he's got more cash than he's ever had in any other period. So you can kind of see during the dot-com crash, the financial crisis right before that, he had built up quite the stash of cash. And he's doing the same thing again. Doesn't mean he's necessarily going to be right, but he's just looking strictly at, am I buying a company at a reasonable price? He doesn't expect to buy it at the bottom or the lowest price, but he expects to get a good value for the money he's investing in. He just doesn't see it right now. In fact, this is just sort of a quote from Buffett, the bottom part: for the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. So again, what he's saying is what you pay for the company matters. It doesn't matter how great the company is. If you overpay for it, you're going to get substandard returns. And Buffett, he can back it up, right? This goes back to 1997. And, if you'd invested in Berkshire versus the S&P 500, you'd have been far better off. So it's awfully risky to bet against Warren Buffett. It's typically how it's done. And the funny thing is about Buffett is really the reason he's had outperformance for the most part is the fact that he has been able to come in after the dot-com crash, after the 2008 recession. That's when he deployed tons and tons of money and bought things when they were cheap. That's what led to his excessive performance relative to the S&P 500. So, I mean, other things is as you look for value, and I don't know when this is going to happen. I've been talking about international stocks relative to the U.S. for a while. And it's still an awfully inexpensive way to invest, but it's just not going anywhere. Right now, the hot story is the United States. So, when you look at this as the average price to book ratio, and you can see the U.S. is just really at a high valuation relative to the rest of the world. Now, there's no question, again, the U.S. is a much better, more dynamic economy. There's no question about that. But just like a extremely dynamic company could lead to substandard returns if you overpay for it, you could look at it the same way for economies. So, all right, yeah, maybe some of these foreign countries, they're not growing like we are. They're not as dynamic as we are. They don't have as much of a tech focus as we do. But this is based on price to book. So it's based on the assets of companies. And if you look at I can show you the same kind of chart based on earnings, actual cash flow back to the investor. That's what you're looking for. This is a busy chart. I apologize. But again, what it's doing is it's comparing the USA to the ex-USA indexes, price to earnings at 15.6 for international, compared to 29 for the US. P&E based on a 5-year average of price to earnings. US is at 35, international is at 18. Price to cash flow, it's at 10 internationally, we're at 20. Price to book, they're at 1.92, we're at 5.29. Price to dividend ratio, they're at 33 times. Their price to dividend ratio, we're at 81. So, I mean, it's just, the tough part is right now, I don't know how much longer the mania is going to go. But at some point, you're going to be better off in some of these cheaper areas, but I don't know when that's going to be. This again just shows you some international stocks relative to US as far as valuations, and it's really exceeded even all historical periods. There's always a cyclical nature to some periods. International does better than US and vice versa. But right now, clearly it's just been US. Another sector, we've talked about this. I was looking for the graph I showed about 2 months ago, couldn't find it, but it showed the 10 different industries that make up the S&P 500 and compared it to historical valuations. And the only one trading below its historical valuation is energy. So, when you look at it, energy is still one area that's extremely cheap compared to its historical norm. And it's an area that absolutely is continuing to grow as more of the third world becomes a bigger economy, bigger part of the world's economic engine. So this just sort of shows you the price of oil compared to the energy sector weighting in the S&P 500. So the weighting of the S&P for oil is as low as it's ever been. And even if you compare that to the price of oil now, even at $70 a barrel, roughly $69 a barrel, there's some potential upside on oil. But again, it could take you some patience to recognize that as far as a return. And then bonds, it's like, bonds have just been, it's been brutal here ever since the inflation hit back in 2021. So we're now looking at probably the longest period of drawdowns, a downturn for the U.S. aggregate bond index, going back to 1976. And you remember 70s and early 80s, it was not a great time for the bond market. But right now we're hitting a period of where 52 months that, the bond market has just been struggling. So it's like, when is this thing going to start to right the ship for investors? Right now we have almost all of our bond holdings in short term, 3 years or less, because it's just, you're not being rewarded to take the risk of longer dated bonds. But at some point you'd think this would turn around, but we've got some serious headwinds for bonds, and for longer dated bonds, it could be bad. And what is that headwind? It is the government and their debt. So, this just kind of shows you what we're projecting here. This shows you the anticipated spending as a percentage of gross domestic product on defense, and also for interest on our debt, what we're paying. So you can see we're at a point right now where we're paying as much in interest as we are on our national defense. In fact, I think this chart's a little bit off. We're actually paying more for interest than we are defense right now. And, I talked about it a while ago. I think we could cut the Defense Department in half and still not affect operational readiness at all. I won't get back into that, but there's so much fluff in the Defense Department and so much bureaucratic waste that if we got it even a little bit more streamlined, we could save a lot of money. But the interest is becoming a serious issue, and you can start to see what's being projected is getting to be more and more alarming. And while it looks like, maybe 6% of GDP going to interest isn't an extreme amount, but we're talking, you're getting well past $1 trillion a year just in interest. That's nothing that's providing any services to us as taxpayers. That's just interest. Another thing to always remember, again, who knows when this is going to change, but companies that pay their shareholders, and one of a famous way is dividends. Now there's other ways they can do it. They can buy back shares, they can pay down debt. That's called shareholder yield. But this is just a chart I saw that was interesting, is just showing you kind of what the returns are for companies that are growing their dividend or initiating a dividend for the first time. You can kind of see from 1973 to 2021. So this is a little dated, but the returns were close to 11%. And look at the standard deviation, which is the measurement for risk. It's 16. And that's pretty low. So you're eventually getting a better return than some of these other kind of companies with a little bit less risk. If you have some that are just regular dividend payers, they're not growing it, but they're just paying it on time, you still get a 9.6. below 17 standard deviation. Non-payers only returned about 5% over that period and had exhibited substantially higher risk. Companies that are cutting dividends or eliminating them, clearly that's a sign of hard times. You're going to get a lot more volatility there with a negative return. And even if you just took the equal weighted S&P 500, so that's just, not a market cap weighted, but just take the 500 companies and they're all have an equal weight. And you can kind of see 8.2% return with about 18% on standard deviation. So again, going back to value counts, the amount of money you get back as an investor is ultimately what you're going to realize as an investor. But right now, dividend stocks aren't sexy. They just aren't. I forgot to do these. So this showed you again, misaligned these two slides. This is just the interest payments on U.S. debt. You can see we've broken the 1 trillion mark. So that's going to be fun. And this also kind of gives you an idea right now, how do we get out of this when entitlement spending, meaning Social Security, Medicare, things like that are anticipated to continue to go up, and our non-defense discretionary spending, there's ways to cut that, but is it going to be enough to offset the increase in upcoming entitlement spending? So definitely some headwinds for bonds too. So jumping around here a little bit again, I just wanted to jump back. Typical price to sales, price to book, we're essentially on a price to sales ratio back above where we were even in 1999. And as far as price to book, we're pretty much where we were in 1999. So again, everybody's chasing the returns. Crypto, this is looking at crypto, how much money is running into that. And I've done a presentation on crypto, and I think on the theory of it, I was always a big kind of believer in it, but it's getting to the point where it's just exhibiting signs of frenzy and not really sticking to its core case that would, I think, attract investors. Same with large company stocks. So mostly the big companies, the money's flowing right into there. I kind of screwed this up, didn't I? So this was supposed to go the other dividend, so I must have mixed those up to give you an idea. So this was just another chart showing you the benefits to dividend investing as far as dividend payers and non-dividend payers. Annualized returns are better, but the other big thing is the volatility is substantially lower. So that's why you always want to look for companies that are actually providing earnings back to investors. So another trend, we watch that I think is going to start to play out this year. Again, I'm not a guy that makes necessarily, guesses of what's going to happen in 25, but there's some problems here in China. Now, some people might look at this and say it's a great time to think about investing in China. I'm never really one of those that feels like it's a great time to invest in China because they manipulate their data so much. You just never really know what you're getting. But of the data that's coming out, it's not looking good for China. And at some point, I don't know, they've been doing a lot of stimulus we'll talk about here in just a second, but things are just not, not looking good. That's the biggest thing. So clearly a lot of money is leaving there. And this is something that's coming here to the United States and piling into tech stocks. So it's providing some tailwind to U.S. tech. But, just looking at the money now leaving China as an investment. And I showed you the crypto and large cap. But when you look at the money leaving Chinese ETFs, it's a massive amount just driving out of there. What's interesting about this chart is the big jump up happened in September when China came out with an absolutely ton of stimulus. I mean, they came out, I'll talk about it in a slide here, huge stimulus. So people are like, all right, let's get back in. And then it just faded fast. So something interesting is happening. If you look at their bond market, this is the yield on their bond market. This clearly shows there's some deflation going on. Now, some people might argue this is the Chinese Communist Party trying to keep rates low to stimulate some activity, economic activity within China. That could be it. But usually when you see something like this, it tells you that there's deflation going on. And the reason is China's they're over indebted. They have put on way too much debt in too short a time period. And they did it in really inefficient ways. I've in years past talked about how they built cities that nobody's living in, and what they do, they tear it down and rebuild it just to keep jobs going. But eventually, when you take on debt and you're using that capital inefficiently, it's going to catch up to you. So you see some deflation because of the over indebtedness, and it's starting to hit their job market too. The number of younger people who are unemployed looking for jobs is hitting highs that they haven't seen in a long time. And, China is always worried about having an angry populace because they're always afraid that at some point people are going to not put up with, the communist government controlling every aspect of their life and overthrowing them. And the big thing I mentioned, so they have inefficiently used some of this capital into real estate, and they're starting to see this year a lot of decline in home sales. The only month that was up was September. And again, as I mentioned, that's when they had a massive amount of stimulus. So an initial bump up when people thought, okay, we're getting some stimulus here, but then it just faded right back yet again. So their total return index for their real estate is down 82% since 21. So that's a heck of a drop. Now it did from 2009, it certainly climbed a massive amount, but it's just about back to where it was. So this is just not good when so much of their economy was based on real estate values. And when those real estate values and activities going down, it's gonna really hit their overall economy. And it's already starting to hit their consumer confidence. You can see not many people within China are all that optimistic. Now, again, I don't know if this data is very good. Data coming out of China, it's never really all that solid. But even if you just say if this whole chart going back to 95 is not solid data, you could at least find some trends within data that's not all that reliable. So there's still a trend there. And as I mentioned, this is what China did back in 26. It was the most stimulus that they've done since 2020 when COVID hit. But they cut the reserve requirements that banks had to have. Their repo rates got dropped. Mortgage rates went down. They put $142 billion into banks and implemented rate cuts, forceful, meaning that they told the banks lower rates on people. So they're trying to get people to spend again, and it's just not working. So they had a very short-term bump in September and October, and then after that, it just faded fast. And like I mentioned, this is just a sign of deflation. And you can kind of see the other periods where they had this sort of deflation, the tech bubble, the 08 debacle. During COVID, they had slight deflation. So it's pretty sizable right now. So, I certainly am not saying this could be a good time to jump in to China. But this is a trend I think that's going to play out over this year. And as always, we have our lawyer saying hello to you. So if you want to read through that, please do. So we turn the video back on. All right, so lots of charts there for you. It's not a prediction, but I've been saying this now for probably a couple of years that, I just look at this market and it doesn't make a lot of sense. Very concentrated with very few names leading it. The names that are leading it are so overvalued relative to any kind of normal investing metrics that you've got. There's clearly a mania going on, whether it's the tech stocks, the crypto. I don't know when it's going to turn. I'm staying pretty conservative. It's not working out for me right now. I'll admit that, but I still try to say, look, am I a speculator or am I an investor? And I want to invest for clients. I want to make sure that we're paying reasonable prices for things that we buy and that we're going to be rewarded with cash flows back to us, whether it's dividends, share buybacks, debt going down, but some sort of way to know that you're going to be compensated for it. But if so, do I think this is the year that's going to change? I don't know. I thought it would change when interest rates went up. Now, if inflation continues to be sticky, the Fed, we had a rough week this week in the markets because the Fed basically said, yeah, it looks like inflation's starting to percolate back up. Inflation will do it. That's what happened in 2022. And that would start it, but that would also be bad for the bond market as well. So, it could be another bad year for the bond market. Who knows? So you just have to kind of look right now and say, where is value? And you kind of go to that. So if you're in the bond market, you still want to be pretty short term, even with the rates being cut by the Fed, for the past couple quarters. They're down from their 5.2%, down to the 4.8. That's not as sexy, but it's a little bit safer to be short term. And it's not that much less of a payout than it was a little while ago relative to taking the risk of longer dated bonds. And then stocks, at some point you're going to be rewarded for buying some value, buying companies with low price to earnings, low price to book, low price to sales. Once people start to actually use the traditional metrics for investing. But right now there is a party going on. There's also a lot of optimism with Trump coming in, at least for a lot of, I guess, the Trump supporters. But generally, even the markets are happy about that. Is that going to manifest itself? I don't know. But I try to tell clients, don't make big decisions based on who's the president. The president coming in, it's sort of like a new captain taking over an aircraft carrier. You just can't turn that thing on a dime. There's not anything a president can do to change something immediately. And, if that aircraft carrier is heading into stormy weather, there's nothing that can be done. Doesn't matter who is the captain of that thing. So I think there's ways you could look at a new president and say, what sectors are going to do well? And then when I do that, I kind of say energy. There's definitely going to be a lot of energy opened up. Exploration is going to happen. So, and we say energy is cheap. So if you have a president that's pro-energy and it's already cheap, it seems like that would be a good place to go. But right now, energy's taken on the chin. So we'll see. I don't know. This is sort of food for thoughts. As I've always said, these presentations are a way for me to get information, answer questions that clients give me, but it's also, you follow me on the process of learning here too. And I've always kind of been a book nerd and like the traditional valuation metrics. And, at some point they'll probably come back in favor, but they're not right now. So we'll see. The key is to be focused on, am I paying a good price for whatever I'm investing in? Real estate, bonds, stocks, whatever. You have to try to think about that stuff. Okay, I don't see any questions. So I will let you all go. I want to wish everybody a very Merry Christmas, a very Happy New Year. And, enjoy the time with family if you can and friends. And we'll see you in January. It'll be a brand new, it won't be picket fence anymore. It'll be Bash and Fiduciary. And again, as the week progresses, probably after Christmas, I'm going to try to get these interviews out to everybody so you can kind of meet the new team. And again, I like to tell clients, really nothing's going to change. You're going to be working with me. The fees stay the same, everything like that. But it's just going to have a little bit more capacity for you, a little more time for clients, a little more education. So it should be a good thing. Anyway, take care, everybody. And again, happy holidays.